All right, so let's start the session number 3 of this exclusive swing trading bootcamp brought to you by Ediglobe. You're with me, Ansh R. Hiran, and today we are going to talk about tool training. Like there are so many tools in stock market. We have talked about Eastern patterns. We talked about Western patterns. We have talked about volume. We have talked about so many things. We have talked about supports and resistances. So you guys have quite a decent knowledge about the price action part of the stock market. Now, today, we are going to talk about the tools that you are going to need, the tools that we are going to use in our strategy and in the upcoming live session, or in making the strategies and in executing the trades. So yeah, today will be tool training. We will be learning about how these tools actually work. And when you learn when you've learned all these things, then we will combine this knowledge to make a strategy which will work in the market flawlessly. So let's get started. This is the third session. It's going to be very, very interesting because uh, for some of you who have some idea about stock market, I know you guys love indicators. Okay, I know you guys love indicators. Or I like to call them tools because indicators is not a good word to be used in stock market nowadays. Now, what are these indicators? Well, you know about the price, which is like the raw data. Okay. And indicators are some tools and some lines, some different things that, some people have created, some, very genius people have created, and they help you to understand the market better. Okay. All these indicators, they give you some sort of signal about the market. Now it's up to you how you understand it. And there are a lot of people who ask me which is the best indicator, which is the indicator which can make you a millionaire or billionaire. It's going to give you very accurate signals about the market. Let me tell you, there is no such indicator. Okay. The indicator is like a sword. I always say this. The indicator is like a sword. It's like a very sharp weapon. If you know how to use it, you can kill anyone with it. But if you don't know how to use it, you're gonna swing it and you're gonna kill yourself or you're gonna harm yourself. So the more, like, if you know there are like thousands of indicators. And recently I was studying this. I was just reading this article, and they said in stock market, in today's stock market, there are more than 16,000 indicators, 16,000 registered indicators. Okay. And let me tell you that in Indian stock market, in NSE, there are around 5,000 stocks. So जितने stocks नहीं है उससे ज्यादा indicators हैं. This is the reality nowadays, right? So which one to choose, which one is the most powerful, that all of this totally depends on how well you know indicator. Like अगर आपको sword चलानी आती है, and if I give you a bow and arrow, it might be a lethal weapon for somebody who knows it, but for you it's just like dandiya, right? But if I give you the sharpest sword in the world, you will be able to kill anyone. This is how indicators work. The indicator you know the best is going to be the best indicator for you. Now, ye to chalo, all these are gyan ki baatein. Now let's start with today's session. Let's start today's tool training. I'll just so third session, everyone, tool training. Let's start. So the first tool that we are going to use and that we are going to learn in this entire program is, of course, moving averages. Now, in case you are in the stock market and living under a rock and you don't know what moving averages are, they are just as the word describes, they are moving averages. Now, you know what an average is. Let's say 2, and then 4, and then maybe 6, and then 8, and then 10. Okay, what is the average of all these numbers? What will you do? You will add all these numbers: 10 plus 8 plus 6, 18 plus 6, 24, 24 plus 8, 28, 24 plus 4, 28, and plus 2, that is 30, divided by number of outcomes: 1, 2, 3, 4, 5. There are five outcomes. So 30 divided by 5, that makes the average of all these numbers as 6. Correct? That's very, very basic, very easy. What is average? Average means the average, right? Average value, like you divide And this is called simple average by them. Okay, there are multiple types of averages, like weighted average, and then you have exponential averages. Then you have some more. I'm not very great at math, but still, there are many averages. Okay, so what is a moving average? Let's talk about it. I'll just take you on the chart only, and I'll explain you there. Okay, this is our simple chart. Let's make it full screen. Okay. All right. So this is a normal chart. Okay, this is any random chart. Let's say TVS Motor Company. What can you see right now, by the way? Can you see something like this? Previous high. Okay, previous high being broken up. Like it's getting a strong breakout. Okay, if I put volume over here, you guys know how to use volume. So if I place some volume, I'll go to the FX and I write VOLUME. Okay. So can you see there is a breakout with increasing volume, which is a good sign for TVS Motors. Should I buy? Should I not? We'll talk about that. Don't worry. But as of now, let's. Oh, sorry. Um, Okay. So as of now, what can we do or what to do? The first thing that we are learning is moving averages. Let's focus on that. What is moving average? As I said, it's a moving average. It's like an average number which is moving along with your price. Okay. I'll show you how it looks like. I'll go to the indicators part and I will write moving average. The moment you write moving average, you will see so many moving averages like moving average adaptive, moving average double, moving average Hamming, multiple, triple, average, channel, exponential, weighted, hull moving average, smooth moving average, not moving average, least square, whatever. So for as of now, we are using moving average, which is simple moving average. In some platforms, you will also get simple moving average, and in this one, you have moving average, which is also simple. Okay. So this line that you see over here, this blue line that you see is called moving average. Okay. This is called moving average. Now, what is the use of this moving average? Let's talk about it. Moving averages are just the average numbers or average value. Now, this, can you see over here? I'll do setting. This is a moving average 9. 9 means this is the average of previous 9 candles. Okay, like 1, 2, 3, 4, 5, 6, 7, 8, 9. So this line, this particular point is the average of previous 9 candles, like this. So all these 9, the value of these 9 candles is summed up and then divided by 9, and whatever the number is, whatever the outcome is, that is plotted with this line at this particular point. Okay, I'll just make it a little bit wider so that you can understand it better. Okay, this one. Now, then let's see moving average 9, and then it's a close. That means it is the average of the closing point of these candles. Like a candle has 4 points, right? Opening, closing, highs, and lows. So this is the average of what? This is the average of closing points of previous 9 candles. 1, 2, 3, 4, 5, 6, 7, 8, 9. These 9 candles, इनके जितने भी closing points थे, this is the average. This point is the average of these 9 points. Okay, and simple SMA means simple moving average. Now, why 9? Because by default you get 9. You can get as many moving averages you as you want. Like one more. Okay, look at this. Multiple moving averages. All of them are 9. I can even change the like number of values that I want to get from this moving average. For example, I want 20 moving average. That means the average of last 20 candles. Or I'll just make it, just wait. I'll do some stuff and then I'll show you what I actually did. Okay, this one is, let's keep it. I'm just adjusting the settings, that's all. And Okay. And let's keep it red. Not no. Let's keep it green. Okay. 9, another one. Let's make it blue. Okay, fine. And I will make it 50. Length. I'm changing the length of average. Okay. That's 50. And now let's make it 100. Let's make the length 100. 100 moving average. And let's make it black. So now on the screen, you can see four different lines. These are four different moving averages. Okay, these are four different moving averages. The yellow one is the smallest one, which is the 9 moving average. Green one is a little bit bigger one, which is 20 moving average. The blue one is even more bigger, which is 50 moving average. That means the average of the closing price of previous 50 candles, and the black one is 100 moving average. It means it is the average of previous 100 candles closing. That's a huge number. I'll put even one more. Okay, let's put one more. And let's make this 200. Now what can you observe? Can you observe anything out of this? Can you? You will see the smallest moving average is reacting to the price very quickly. Like yellow one is moving like zigzag up, down, too much. The green one is reacting to it, but it is reacting to the bigger trends, a little bit bigger trends. And but again, it is also quite active with the market. The blue one that you see, which is 50 moving average, it is responsive, but it is responding to a bigger trend. Okay, a bigger trend, like it is going up, so it's going up. The trend is going down, it's going down. If the trend is going up, it is also going up. There are some fluctuation, it is turning a little bit. The black one, if you see, it is only affected by, if I show you, uh, the black one is only impacted by some major sideways market. Otherwise, it is not impacted at all. And the purple one, which is 200 moving average, it is not. It is like showing you the overall trend of the market. If the overall trend is upward, the 200 moving average is also going up. If the overall trend is downward, look at this over here. When there was a good downward trend for a 3 years period of time, 3, 4 years, that time it was in a downtrend. Why? Because these small ups and downs are not impacting the 200 candles moving average at all. But if it is just an average of previous 9 candles, and if the next 2 candles are going down, then the entire average can be disrupted. It can go up and down as well. Simple logic. Okay. The smaller moving averages will react to price quickly, and the bigger, as you go bigger in the moving averages, they will be impacted by the overall trend of the market. Now, what is the use of these moving averages? Now, there are two uses. Okay, I'm going to tell you both of them. Let's understand this. First use is these moving averages act as a very, very strong support and resistance in the market. Okay, look at this. I will just give you some example. 200 moving average. Okay, exact support in the market, and then the market goes up. Whenever the market comes to this level, exact support, market goes up. Exact support, market goes up. Exact support, market goes up multiple times. Resistance, market goes down. Resistance, market goes down. Resistance, market goes down. Support, market goes up. I'll show you 100 moving averages. Look at this, multiple time. 100 moving average, resistance down. 100 moving average consolidating, trying to break out, but down. Resistance down. Resistance down. Resistance down. Exact support up. Exact support up. Trying to take support up. Exact support up. Trying to take support up. Multiple supports and resistance you can see on all these moving averages. Whenever the price, okay, look at this. No, there is not. Look at this. Exact support on the 100 moving average, then going up. Then I'll show 50 as well. Look at this. Exact support on 50, up. 50, up. 50, up. Here support, up. And this is just a random stock. You can take any other stock. Give me an example like um, what can we take? India Bull Housing Finance. Let's take that for an example. Yeah. Okay, these are some levels that I've marked. And can you see? This is exactly where the market stopped going down and now it is going up. So yeah, all these things are there. But yeah, don't worry about that. See, 50 moving average up, 50 moving average straight up, 50 moving average up, 50 moving average down, right? Zigzag on these, consolidation on all these moving averages. Uh, where can you see the support resistance? Okay, 50 moving average up, 50 moving exactly on 50 moving average going up. Support 50 moving average going up. Multiple times the market will take support. Let's take another moving average, which is 20 moving average, for example. Okay. Look at this. Look at this multiple times. 20 moving average up, 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 20 moving average down. So resistance and down. Resistance 20 moving average down. Support on 20 moving average up. Support on 20 moving average up. Support on 20 moving average up. Support up. Resistance down. Exact support up. Resistance down. Resistance down. Exact support over here went up. Exact support up. Right? And then I'll show you 9 moving averages as well. Now it is very, very small reaction. So let's find out where now 9 moving average is. So look at this. So this is like a candle wise support resistance that you can see because it's a very reactive moving. And look at this. It went up, took a resistance down. Took a support going up. Took a support, went 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 up. Like this. It takes support and resistance on these levels multiple times. Multiple times. So the first use of these moving averages is you can use them as support and resistance. And second use of these moving averages is you can also take trades on the basis of two moving averages. Two. First one should be smaller, second one should be bigger. Why? Because you see, when you follow a trend, okay, if a trend is changing, let's say there's a downtrend going on, so all moving averages are down, and now the uptrend is starting. Which moving average will respond to the upward trend quickly? Or firstly, the smallest one, and then the second one will react, then the third one, the bigger one will react, then the fourth one, bigger one will react, right? So according to this simple logic, so many people have made the strategy that okay, this yellow one is the 9 moving average, green one is the 20 moving average. 9 is smaller, green is bigger. Okay, so whenever the yellow one grows, yellow one goes up, goes sorry. So whenever the yellow one crosses the green one and goes above it, okay, you buy. So for example, here yellow one is going above green one, okay, it's crossing the green one and going above it. You buy at this level and you continue to hold this position till the green one is below yellow one. So look at this. You bought at this level, the market is going up and up, and here you will exit your position because the green one is coming down. So you bought at this level, you're selling at this level. This is your profit from, at least if you expect 159 to 192, again it's like a 35% profit. Another one example, yellow going up, green going down. You buy at this level, you sell at this level. You can also short sell. If the yellow goes down, green goes up, you short sell, you sell over here, and the market goes down, it keeps on going down, and you cover your position at this level. Yellow goes up, green goes down, you buy at this level, and you cover your position at this level. Yellow goes down, green goes up, so you sell at this level, and you buy again at somewhere over here. So you're capturing the entire movement. This is another use. If you want to capture the bigger moves, you don't want to be stocked out in these fluctuations, you can take bigger moving averages like 20 and 50. They will give you bigger trends, or 50 or 100 for that matter. Look at this. So they are not impacted by these small fluctuations. You buy at the bottom at these levels and you hold till this level. So you are buying somewhere around 98, you are selling somewhere around 180. That means you are doubling your money. You don't sell in these fluctuations as well, and you hold for a bigger target and bigger overall movement. You want even bigger trend, you can go for 900 and 200. Look at this. It is still saying you should buy it right now, like you should hold this position, because it has still not given you a sell signal yet. Right? So bigger the moving average, bigger the trend it will capture. Smaller the moving average, smaller it will capture. And like this, you can make multiple moving averages of your own, like 20, 30, 35, 80, 90. It's your wish. But which one to use? Now you know about moving averages, they act as support and resistance. They You can also use them for the crossover, moving average crossovers, okay, as a buying and selling signal. Now, which moving averages are the best? You will get this question as well. So the moving averages that we did, 20, 50, 100, and 200, these are the best moving averages in my opinion. You shouldn't even use 9. No need to use that. 20, 50, 100, and 200 are the best moving averages. Okay. We also use exponential moving. This was a simple moving average, but sometimes you also use exponential, 200 exponential moving average for some strategies that we're going to discuss in the strategy part. But yeah, most of the time we are going to use 20 moving average and 200 moving averages. Also, 50, 100 is also a very strong moving average. Now, you might be wondering, or you might have this question in your mind, that why these particular moving averages? Because there can be thousands of them, right? So the answer to that question is, when I talk about 20 moving average, okay, I'm talking about 20 previous candles. If you see in a month, how many working days are there in the stock market? Almost 2021. So when I'm taking a 20 moving average, looking at 20 moving average data, I am actually looking at the average price of the entire month. Okay. And that is important. When I talk about 50 moving average, it is like average price of a quarter, 1 quarter of a year. When I'm talking about 100 moving average, I am actually looking at average price of half a year. And when I'm looking at 200 moving average, I'm actually looking at the average price of previous 200 candles. And in a year, there are 200 working days, almost 200 working days. So when I look at 200 moving average, I look at the average value of a particular stock of the entire year. And these few logics make these moving averages very powerful. And to be very clear, because they work, that's why I use them. I'll be very honest and very frank. Okay, so this is the power of moving average. They act as support and resistance, and they can also tell you about the trend of the market. Now, another tool that we are going to use is something called as Bollinger Bands. Okay, note down Bollinger Bands or Bollinger Bands. Some people call them Bollinger, some people call them Bollinger. It was created by a mathematician called John Bollinger. Okay, you don't need that information, but still, this looks like this. Okay, this is a band. This is a band which moves along with your price. Okay, this is a band which moves along with your price. It has three components. First one is middle band, second one is upper band, and third one is lower. And the price moves between these three bands. Now, let me tell you what are all three, all the these three bands actually mean. Okay, let's check this. Have you heard about this word called standard deviation? Okay, if you are from math background, if you are from engineering background, you might be knowing this. You might have seen this thing in your sciencey books. Okay. And this is called uh, a bell curve. Okay. This is called a bell curve. Now, what is this? This is actually a data set. Data means what? What is data in market? Data means price. So price can be this, can be this, can be this, can be this, can be this. Okay. Now, now all these price, if you take the average of all these price, it will be somewhere in the middle. Okay. This is called mean. Okay. And you can just uh, sorry for the bad line. Yeah, this line is called the average line or mean line. Okay. Now this is the average line, but can you see all these values or all these data points that we have gathered? They are little bit away from the this average, and this distance from the average is called deviation from the average. How deviated your observation is from the average, that's called standard deviation. Okay. And standard deviation says, if is this rule says, if your if you go one standard deviation away from your mean or from your average, like this, one step in this direction, one step in this direction, this is like one standard deviation away in this side, one standard deviation away this side, you will be able to capture 66% of the data. So you can see 66% of observations are in this only. If you go two steps away or two standard deviation away from your mean average data, like somewhere over here in the positive side, this is infinity, this is minus infinity, you will be able to capture in this entire block, you will be able to capture 90, I think 95% of the data. Yeah. I'm not sure about these percentage, but yeah, that's almost something like this. And then if you go three standard deviation away from data, you will be able to capture 99 point something percent of the data. So you can see if you go three steps away, like you have captured majority of the data. There is only one or two values which are out of this standard deviation. Correct? Now, if you have this much of knowledge, that's more than enough for me if you understand this. Now, what are Bollinger Bands? Bollinger Band is nothing but a standard deviation band. Okay, standard deviation band. That means what? There is an average, which is the middle band. This middle band is also called 20 moving average. You guys know what 20 moving average is? We just talked about it. So this middle band is nothing but 20 simple moving average. I told you, right? It's very, very powerful. It is also used in many tools. Okay. And this upper band and lower band is nothing but the two standard deviation line, this one on the positive side, and two standard deviation line, this one on the negative side. So two standard deviation line on the positive side and two standard deviation line on the negative side. And now we know that 95% of the time, the values or the data will be inside these two lines only. You can also see over here, 95% of the time, the price is inside the Bollinger Band only. Only 5%, like this, like these. Okay. Uh, that's when the price will actually go out of the Bollinger Band. Okay. Now, if that part is clear, this is how like the Bollinger Band is formed. If you don't know this, that is fine. But if you know this, that's great. Okay. Now, how to use this Bollinger Band? This Bollinger Band can be used firstly as support and resistance. The middle band, which is 20 moving average, upper band, and lower band, all three bands can be used as a very strong support and resistance in the market. Look at this. Uh, Support on the lower band going up, resistance on the upper band going down, support on the lower band going up, resistance on the upper band going down to the middle band. Middle band is what 20 moving average. This is also support and resistance. So went up. Again, came down, consolidated, went up. Resistance on the upper band, came down. Support on the lower band, went up. Right? So you will see multiple times the price will take support and resistance on the upper, middle, and lower band. Okay. These are also called volatility bands. Volatility. Remember the seven factors that we consider before trading? Price, pattern, volume, what? Price, pattern, volume, momentum, volatility, time sentiment, and trend. So volatility part will be covered in by using Bollinger Band only. Okay, let's talk about this. So majority of the people, they know Bollinger Band uh, as a tool for identifying supports and resistances. And I'll also tell you the first independent swing trade that I personally took, was purely based on Bollinger Band only. Okay. I remember the stock was Gale. I bought when the stock came down to the lower band and I sold it with a 10% profit. Okay. It was like it went up by 10%. I sold it in 10% profit. I think in a week I got the target. So that was the first independent trade. I was trading based on tips and all, but the first independent trade that I took, first independent swing trade that I took was purely based on Bollinger Bands. Okay. Now, uh, let's just random information. But this is what majority of the people know. But that was the only profit that I got based on that concept because, as I said, the more you know about a tool, the better it gets for you, the stronger it gets for you, and that becomes the most powerful tool. So now we will understand this simple tool in much more detail. Okay. So another concept of Bollinger Band is Bollinger Band's squeeze and breakout. Okay, squeeze and breakout. What do I mean by that? Look at this. Bollinger Bands are also, as I said, they are also called volatility bands. Volatility bands. What is the meaning of volatility? Volatility means the craziness of the market. Craziness means the market is going up, the market is going down, it's going up, down, making big crazy moves. That is called volatility. Okay, sorry, what happened to my camera? Okay. That is called volatility. And if the market is making crazy big moves, that is called volatile market. Okay, that is called volatile market. Now, and if the market is very, very, shant and decent, it is going a little bit like this, going up slowly, going down slowly, it's in a perfect trend, then that market is not volatile. When the markets are not volatile, what will happen is the Bollinger Band will start squeezing. It will start squeezing. Okay, the area of the Bollinger Band will be narrowed down like this. Can you see squeeze low volatility zone? Okay. And then what will happen? See, the market cannot be very less volatile all the time. Once there is very low volatility, then the market is just waiting for a news, for an update, or just for a small push, which will take the market. Like it's like you are in a jail. Okay, you are in a jail, and it's a very small jail. So the moment the doors are open, you will just run away out of it, right? So same thing happens in the market as well. The moment the market gets a push, market gets some volatility, it gives a breakout of the volatility and it starts moving like crazy. And when this happens, the Bollinger Band also expands. It also expands. If it's expanding, now if you see what was happening when the Bollinger Band was narrowed down, it means the entire movement of the market is like this only, a small movement. How much money can you make over here? But now when the band is expanded, now because the volatility is more in the market, now if you take a trade here, you can target this level. Or if you buy at this level, you can target this. So this is a much, much bigger movement. You can get much bigger targets. You can get much bigger profits. right? So little bit of volatility is very much required. Otherwise, you cannot make money in a very slow market. It's very, very difficult. Okay. So, and one more thing. Okay. When the Bollinger, when the price breaks out of the Bollinger Band, like can you see the price was inside the Bollinger Band all the time, but now because the volatility has increased, price has broken out of the band. Can you see the closing is outside Bollinger Band? This is the Bollinger Band. The closing is outside the Bollinger Band. This concept is called walk or walking on the band. Okay, it can be on the lower side as well. If it has if it would have given a breakdown, then it would be walking on the lower band, walking on the band. When the price is walking on the band, it means the price is very volatile. And when the market is outside Bollinger Band, it means market is very, very volatile. When it comes back inside, it is a little bit less volatile. Okay, so this is called walk on the band. I'll show some more examples. Look at this. It was very, very quiet. Then it gave a strong breakout on this candle and it gave a crazy, crazy move. Now look at this, how much the radius of the market has increased. Look at this. Not just work on the stock market. Look at this. Crude oil, correct? Very tight squeeze, very tight. And tighter the squeeze, louder the move. Okay. Longer the squeeze, tighter the squeeze, louder the move. So look at this. Very, very narrow range. And when it gave a breakout, it moved like anything. Look at this. Crazy moves. Look at this. Very tight squeeze. Very small range. The moment it gave a breakout, what is this? Ethereum, Binance, Therex, whatever it is. It is what? This is the cryptocurrency. Breakout and strong move. Right? This is showing you how the volatility in the market increases and what actually signals us about the volatility. We have a strategy based on this simple concept that we use in options, but that's not for you as of now. But yeah, this is also something that we use a lot. Now, moving on, this is like, you got to capture the trend. In a way, you can also capture the trend. If like short at the breakout, you can, ride the trend. If you buy at the breakout, you can ride the trend. This can be done, right? Now, let's talk about reversals. Okay, let's talk about reversal. What is reversal? Reversal means now you guys already know there are so many reversal patterns and all, but and you also know about the Western patterns of reversal like double top, right? Double bottom, head and shoulder. Okay, inverse head and shoulders. Correct. You know a lot after doing what you've done already, after doing the pre-training sessions. And I hope you practice that. Okay. I know I'm not giving you so much of time, but this is, again, as I'm saying, it is a crash course. Okay. You opted for it. You wanted a quick outlook of the market and you wanted quick strategies to learn the stock market. So here it is. You opted for it, right? Otherwise, I suggest that, okay, you need to practice for at least 6 months, 1 year to become a trader. But क्या कर सकते हैं? You wanted something very quick, right? So that's here for you, right? But again, I would suggest keep you have the recordings with you. Okay, you have the recordings with you. Watch them again. Watch them again and again and again and again for next 5 months, 6 months. Just binge watch it. Maybe on every weekend initially. Then you can watch it every alternate weekend. Then you can watch it once a month. See, I'll tell you. Even now, when I watch the recordings of my mentor, okay, and I did these courses like 6 years ago. So even now when I watch the recordings, I get some or the other insight from them. It need not be the crux of the strategy, but it is just something that they said in the flow. And when I was learning, it was not making much sense. But now, because I have some experience, that small point is making so much sense to me. And now I'm realizing, okay, whatever he said had a meaning. It has a meaning, right? So watch these recordings again and again. It will not just brush up the entire thing. And I know you're going to watch it on 1.5x or 1.75x. Some might even go to 2x. Uh, but watch it. Okay, watch it again and again and again. You will get some great insights of the market. Practice, watch again, practice and watch again, practice and watch again. You can master this thing. Trust me, you can master this thing. Let's talk about reversal. So you guys know about Western patterns of reversal. You guys know about Eastern patterns of reversal. Now let's see how Bollinger Band can signal you reversal. There is something called as divergence. Divergence means, I hope I'm writing the. Is the spelling right or divergence? So, yeah, correct. But spelling is right. Anyways, yeah, because I'm actually very confused in this spelling thing right now because of the autocorrect and spelling assist and everything that you do. It's very difficult nowadays. At least for me, it is to remember the spellings. Never mind. So divergence. What is divergence? Divergence means it is diverted. Diverted from what? Diverted from price. Anything in the stock market can only divert from price because price is the original data. Divergence means, and when I talk about Bollinger Band to use as divergence, I'm talking about something called as volatility divergence. What do I mean by that? The simple meaning is price is saying one thing and your volatility is saying different thing. Price is saying I am going up, volatility is saying I'm going down. Price is saying I am at the same level, volatility is saying no, I'm not at the same level. This is a divergence. Okay, how do you know that? Look at this. What can you see over here? Can you see a double bottom? First bottom, second bottom. Can you see W pattern? Double bottom means what? There are same lows. Okay, same lows. But now, when you look at this double bottom, can you see first bottom is outside Bollinger Band and second bottom is inside Bollinger Band? What does this mean? This simply means that when first bottom was formed, the volatility was very high. When the second bottom is formed, the volatility is very low as compared to this one. The price is same, volatility is different, हो गया divergence. And when there is a divergence, there comes the reverse. Now, this is just the volatility confirmation. You know about this pattern, W pattern, perfect, no issues. Then you will look at the volume, whether the red volume is higher in this one and going down gradually, and the green volume is increasing or not. That's volume confirmation. Then you will check momentum, we'll talk about it. Then you will check volatility as well. That okay, is the first one outside and second one inside? That means you are getting confirmation from the volatility as well. And if you're getting the confirmation from all of it, the possibility of this pattern going wrong is very low. As I said in the last session as well, you will get, let's say, 50 double bottoms in one go in the stock market. Out of those 50, you can only trade 5 or 7. So how to filter out those 5 or 7, which are very high probability? You will look at all the criteria. Now, if you just know the W pattern, you have to trade all 50. Some of them might go wrong, some of them might go right, some of them might not give you anything, nothing to do. But when you take all these confirmations, then first you confirm with the volume, then you confirm with the momentum, then you confirm with the volatility. What happens is firstly you are shortlisting the best one out of them, and those best one has the highest probability to give you a bumper move. Right? So this is called volatility divergence. Let's look at some more examples. Look at this. Double top, first top outside Bollinger Band, second top inside Bollinger Band, neckline broken, and the market goes down. Volatility divergence. Triple top, triple bottom. First outside, second inside, third inside, fourth also inside. It's like consolidation, and the volatility is coming down. Right? Can you see? Same level, but volatility is going down. At the same time, Bollinger Band is also squeezing. What does that mean? The volatility is actually going down. The moment it gives a breakout, the market goes up. First bottom outside Bollinger Band. Second bottom inside Bollinger Band. Whenever the neckline is broken, you take a trade and the market starts going. First top outside Bollinger Band. Second top inside Bollinger Band. Neckline broken, market goes straight down. First top outside Bollinger Band. Second top inside Bollinger Band. Third top inside Bollinger Band. Neckline is broken, market goes straight down. Okay, this is a little bit confusing. Okay, look at this. Okay. First top outside Bollinger Band. Second top inside Bollinger Band. Neckline broken, you get the target. First top outside Bollinger Band. Second top inside Bollinger Band. This is the neckline broken. The market gives you the lower. First bottom outside Bollinger Band. Second bottom inside Bollinger Band. Neckline broken, goes up. First bottom outside Bollinger Band. Second bottom inside Bollinger Band. Neckline broken and the market starts going up. First top outside Bollinger Band. Second top outside inside Bollinger Band. Neckline broken, market starts going down. First top outside, second top somewhere in the middle, third top exactly inside. Divergence gives a breakdown, market goes down. First top outside Bollinger Band, second top inside Bollinger Band. Neckline breakout and the market starts going down. First top outside, second top inside. Now this might not look like a M pattern to you, but if you see green candle going up, red candle, green candle, red candle, green candle, and then red. So it's like a triple top and then the breakdown. First top, second top, third top. Neckline broken, market went down. First is outside, second is somewhere in the middle, third is completely inside. First top outside, second one in the middle, third one uh, inside, neckline breakdown and straight down. First top, second top, third top, fourth top. The entire consolidation is reducing the volatility. Whenever it will give a breakdown, market boom. Also, this is also what? This consolidation flag pattern, breakdown of the flag pattern and down. Now, also, see, the more you know, the more you understand the market better. Like, look at this flag pattern, breakout. It is also giving a breakout of the squeeze. This is a squeeze of the Bollinger Band. So the volatility is also increasing when there is a breakout. So you're getting a confirmation of the breakout as well. And the market goes straight down like this. Correct. Look at this. First shoulder outside Bollinger Band, head outside Bollinger Band, second shoulder inside Bollinger Band, neckline broken straight up, head and shoulder as well. The more you see, the more you like it. The more you see, the more you like it. That's why so many examples. First bottom outside Bollinger Band, second bottom inside Bollinger Band, neckline broken, and the market goes straight up. Here, can you see a double top, double bottom? If you can't, you should. I'll show you. This is the bottom. That's a red candle. Okay, then the market goes up because it's a green candle. Then market goes down again because the red candle. Then it starts going up. So if you see, if I make it a line chart, you will see it clearly. First bottom, second bottom, W pattern, double bottom, neckline broken. First outside, second inside, neckline broken, market goes. Interesting, making sense. Yes, logical, everyone. Tell me. Now you can't tell me because it's a recording, but I hope you guys are responding like this on that part of the screen. Now we have completed the volatility part. Now this is just a tool training. I'm not telling you where to buy, where to sell. We are going to cover that in the strategy part. Don't worry. I'm just making you understand the tools that you should know before understanding the strategy. Okay. You got that? Now, another tool that we are going to understand is called RSI or Relative Strength Index. Note it down. RSI or relative strength index. All right. So what is this? This is our momentum indicator. Okay. This is our momentum indicator. Now, what is momentum? Of course, price, pattern, volume, momentum, volatility, time, sentiment, and trend. Correct. So the fourth one is momentum. What is momentum? Momentum basically means the speed of the market. Okay, speed of the market. At what speed the market is moving. See, in market, speed is very, very important. Why? Because let's say there is stock A which is going from 100 rupees to 200 rupees in 1 year. And there's another stock which is stock B which is going from 100 rupees to 200 rupees in 5 years. Which one is going to give you better returns? Of course, the returns are 100% only. But first one has given you the returns in 1 year, another one has given you return in 5 years. Which one is better? Returns are always seen with respect to time. Okay, on paper the returns are same. You bought it 100, sold it 200, return is 100 rupees, but that 100 rupees is made in 5 years. It's like 20% return a year, and another 100 that you made in 1 year, it's 100% return a year. That's a big difference. That's why we need momentum. We need speed in the market. If we want, keep whichever stock we buy, if it has to go up, it should go up with a good speed. If it has to go down, it should go down with a good speed. Otherwise, we are not interested. That's why we use something called as RSI or relative strength index. Now there are two types of RSI. First is called conventional RSI, which you get by default. Okay, which you get by default on all the platforms. Okay, it looks something like this. It has two levels. First one is 70 level that you can see over here, upper level, and then lower level as 30. And this black line is called RSI line. The conventional way to look at RSI is like they say, whenever the RSI goes above 70, whenever the RSI line goes above 70, that means the market is overbought. It is overbought. That means what? It is overbought means people will start selling this because they don't have the money anymore. It is overbought now. It is overvalued, overbought. They will start selling it. The market will go down. And when the RSI is below 30, they say the market is oversold. That means people have sold beyond their capacity. So they don't have the money to sell anymore, or the stock doesn't deserve to go down anymore. Uh, that's why this stock, the buying will emerge in this particular stock and the stock will go up. Now, I want to ask you one thing. RSI is a momentum indicator. Correct? Making sense? Momentum means speed. For example, you have your speed indicator in your car, right? Speedometer in your car. I want to ask you this thing. What is the work of your speedometer in the car? Is it there to tell you that, okay, you are going too fast, slow down, or you are going too fast, so you will have to take a U turn, or your fuel is going to be empty, or you're going too slow, you have to speed up? No, that is not the work of speedometer. Speedometer's work is to tell me whether I like what speed I'm going at. Just tell me that. That's the entire purpose. Whether I'm going fast or I'm going slow, that's my that's all you have to tell me. Whether I have to take a U-turn or whether I have to stop or whether I have to, to make a reversal or whether I have to, take a reverse. That is my point of view. That's my destination that I have to decide. You just tell me whether I'm going fast or slow. Then why the speedometer of the market, RSI, because it's a momentum indicator, why the speedometer of the market telling me that the market is overbought, it will take a reversal, market is oversold, it will take a reversal? Why is this saying? That's why this conventional use does not work very efficiently. And that's why we use an unconventional approach of looking at RSI. We just change these levels from 70-30. We just change it to 60-40. I'm going to show it to you how it's done. But just as of now, understand this. And after changing these levels to 60/40, the rules of RSI changes, and it simply becomes like above 60. If the RSI is above 60, the stock or the index is in bullish momentum. Bullish momentum means it is going up and going up with a good speed. If the RSI is below 40, that means it has a bearish momentum. That means the market is going down and going down with a good speed. And if the RSI is between 60/40, that means the market is not going anywhere. It is just sideways. Okay. These are the golden rules of RSI: above 60 bullish, below 40 bearish, between 60/40 sideways. Note this thing down in your notebook. Golden rules of RSI: above 60 bullish, below 40 bearish, between 60/40 sideways. All right. Now you noted them down. See the first. Let's see the example of this. Okay, I will go to the same chart. Okay, or what was the chart previously? TVS Motors, right? Let's replace that. You will go to indicators. You will write RSI. Now you will see so many RSIs on TradingView. You will see so many RSIs. But I'll choose TradingView. Okay, I don't need that as of now. There's the volume. Okay, let's plot TVS Motors. You'll go to indicators. You will write RSI. You will see so many indicators like RSI divergence indicator, RSI strategy, RSI Connor, and whatnot. Simply click the relatives to index RSI. Okay, first one, and you will get something like this, which I was saying. The upper level is 70, the lower level is 30. Now they say if the market goes above 70, it is overbought. Let's say it goes overbought over here. It became overbought here at this level. Can you see? I hope you guys can see it. Okay, this stock went overbought at this level. TVS Motors, it went overbought at this level. So it was supposed to go down. People who would have shorted this at by looking at the RSI at this level, imagine what would have happened to their capital after 1648. The stock went all the way up to what's the price level? 2308. Still no sign of corrections and going up, right? So this is a very, like, look at this. Here it said, okay, we are going above 70, that means we are overbought. After showing overbought, it went all the way up to this level. And then also there is no sign of correction. It was just consolidating for some time and then went up again. Look at another signal. It went above 70 at this level. Okay, this is the overbought zone. After the overbought zone, the market went up like crazy. This is the wrong thing, and this is the approach of conventional RSI, which we actually don't use. What we use is unconventional. So what do? We go to the settings of RSI over here. Okay, and you will go to the length is 14, close, that's all is fine. You will go to style. Okay, as of now, all you need is upper level, lower level, sorry, upper RSI, upper level, lower level, and RSI. You don't need all these different things. So you just need RSI. I'll make it a black in color so that it becomes much more. Okay. RSI based MA, you don't want that. You don't want upper Bollinger Band in RSI, lower Bollinger Band in RSI. You don't need regular bullish or that stuff. Okay. You don't need anything like that. You don't need all these things. You need RSI upper band. Yes. We need RSI upper band, but we want it to be not 70. We want it to be 60. Okay. Done. I'll just make it green in color so that you can like see this properly. Okay. We don't want the RSI middle band. We have no use of it. We need RSI lower band, and we don't want to be 30. We want it to be 40 because 60/40 RSI. And I'll just make it red so that becomes much clearer. Okay, so upper band, upper RSI band, lower RSI band, and RSI in itself. That's all. We don't any of that. Okay. Now this is our unconventional RSI, 60-40 RSI or proper momentum indicator. Now, what does this say? Whenever the RSI goes above 60, that means this is the level of 60, right? Our line 60 line. Whenever the RSI goes above 60, it gains bullish momentum. It goes up and goes up with a great speed. Look at this. It goes above 60 at this candle and market going to go straight up. The moment till the RSI is above 60, the market is continuously going up from this level to this. And look at the speed at which it is going. Right now, what has happened? Started going up on this candle. Speed, RSI above 60. Started going up on this candle. Good speed. Some bigger trends, good speed, went up. Bigger trend is this one, even bigger, above 60. And you won't now look at this. Above 60, straight up. Above 60 over here, straight up. Look at this. Above 60 over here and straight up. And whenever the RSI is between 60-40, look at this. 60-40 ke beech mein, market is sideways. Right? Making sense? That's how you like learn everything in detail. Right? ऊपर ऊपर से YouTube से पढ़ के कुछ नहीं होगा. Trust me, कुछ नहीं होगा. Zigzag, zigzag, because RSI is zigzag, zigzag. RSI even went below 40 for some time, right? It means market is very bearish. Look at this. Market went down. I'll show you stock in Infosys that was in downtrend. Look at this. RSI went below 40. Here, look at the candle. Market went straight down, 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 down. RSI went above 60. Market went up. Below 40, went down, down, down. Above 60, went up, up. This is how it works. Okay, so that's your first concept, which is RSI 60-40, 60-40 rule. Now, the concept number 2 for today is this. RSI level also act as strong support and resistance. Again, support and resistance is not going to leave you, at least till the point you're in stock market. It's not going to leave. So instead of buying on breakout and crossovers, RSI 60 crossover or RSI breakout, we can also look for buying opportunities at 60 support or 40 resistance. What do I mean by that? See, this 60 level and 40 level will also act as resistance. So if you are unable to buy at the breakout of the RSI, when the RSI goes up and you missed it, you can also buy when the you can also buy when RSI takes support on 60. If it takes support on 60 like this, you can buy and then you can continue trade. If you would have short this, let's say RSI is below 40. So if you want to short at the crossover or RSI crossover or RSI breakdown, you can, that's great. If you missed it, you can look for the buying opportunity or selling opportunity when the market comes and takes resistance at 40 and then moves. I will show you how. This is the breakout candle. This is the breakout candle. So you buy above this candle, breakout candle के above buy, and if you see this is a resistance as well, right? ये एक resistance था previous high का, so यहाँ पे भी था तो breakout भी हो रहा था. You buy above the breakout candle, right? Because that's a confirmation. So this is your buying level. Okay. In case you missed it, what will be your stop loss? Your stop loss will be somewhere here. Breakout candle ka low will be your stop loss. In case you miss this, where can you buy? अब miss हो गया, you can't buy here because in that case your stop loss will be very very big, right? You can't buy here. So where will you buy? You will buy at support when the market goes, when the market takes a dip. Okay, RSI will also take a dip. Why RSI will take a dip? Because RSI work on the closing basis. Okay, if the candle is red, it is closing lower than the previous close, RSI will go down. If the market is green, if the closing on a positive note with a green candle, RSI will close higher. Okay. Anyways, so whenever the market gave a small dip, there's something called as buying on dip. Whenever the market, you don't buy when the market is going up. You buy when the market gives a small dip, so you can buy here, and then the market will go up again. You can buy on this dip, and then the market will go up again. Buy on the dip, market will. So this is called buying on dip. Okay. So whenever market gives a small dip and takes a dip on RSI for 60 as well, takes a support on that, you buy at that level, and then the market zooms up again. Why? Because these level also act as support and resistance. And now, because you have bought near 60, because you have bought at a support level, now your stop loss will be this, not this anymore. So your stop loss will be small, targets will be big. Look at this. Now, RSI went above 60 because of this green candle or this red candle. Why? Because it's a gap of opening. So closing is much higher than the opening, right? There's a gap up. That's why the market opened. The RSI is above 60. Now you can't buy here above the high of this because the stop loss will be very, very big, somewhere below the breakdown candle. So what can you do? You can wait for a support, RSI 60 support. Where is the market taking support in 60? It is not a perfect support, but fine. Here, the market is taking support almost on 60. That's where. So you buy about this candle, and then the market starts going up. By the way, you guys also don't know how the support and resistance work, right? How you can buy on support and sell on resistance. So now, so far, you know about how to buy the breakout. Wherever the candle gives a breakout, you buy above the high of that candle. You know that. And now, most of the time, we put this as a stop loss. Now, what happens in the case of support and resistance? Let's talk about that also. Okay, let's talk about this first, support and resistance. Support and resistance, how to buy at support and how to uh, sell at resistance, when to buy actually, at what time you should buy. Let's see this. Let's say this is a support. Yeah, the market went up, it came down. Okay, so let's say there is a red candle which is taking support. Now, you know, a professional trader only trades on confirmation. They don't trade on anticipation. They only trade on confirmation. So what is the confirmation of this? What is the confirmation that this will take support? What is the confirmation that this will not go down like this tomorrow? There is no confirmation yet. So far, there's no confirmation. So what will you do? We will wait for the confirmation. What will be the confirmation? The confirmation is if it makes a green candle and starts going up. Now, if you wait for two, three candles, that's a different story. But where you can enter is there are three scenarios. Okay, three scenarios. First one is if the price, three or maybe more. Okay. If the price makes something like indecisive candle or a hammer, it can be green or red, fine, okay. Inverted hammer, something like this. If the market is giving you such signals, then you can buy above the high of these candles. So if the next candle which is formed, let's say it's a green candle, and it crosses the high of these candle, you can buy the moment the candle crosses the high, and then the market can go up. Another scenario is market was going down, made a red candle. Okay. So let's say it did not make any pattern as such, but it made a candle like this. It opened at this level. It was going up, 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 up. So the moment it crosses the high of your last red candle, which took a support, the moment it crosses the high of the last red candle, that means it is going above the previous day's high. That means it is actually taking the support and now going up, moving upward. So moment it starts going above the previous high, you buy, and then the price can start, which will also work like tweezer top and buying at tweezer top or engulfing, whatever you call it. But yeah, that can also be the case. Then another case is the market was going down. Let's say this candle took the support, like on near the support. Then there will be a small green, normal small green candle, which is not making any pattern as such. Okay, it might make an inside bar which is bullish, harami, or some other patterns as well. But don't worry. Let's say if you don't know any pattern at all, okay, which is a small pattern which has not crossed the high of the previous candle as well. But what has this thing done is this has confirmed the support. Okay, the market was going down. This has said the market is not going down, it's taking support and going up. So the next day when the market will open, you will place your buying order above the high of this green candle. So once the high of this green candle is breached, you will buy and the market will start. These are the three ways you can enter into the market. Okay, if the market makes a pattern, buy above that. If the market crosses the high of the red support taking candle, you buy above that. Or if it not crosses the high of the support taking candle but makes a green candle after near support level, you buy above the high of the green candle. That's how you buy on the support. Now tell me. So you know about the break, how to buy about the breakout. Now this time the uh, market was going down. That means the RSI was also going down, right? This red candle took the RSI near 40, so 60 levels. Perfect, no issues. So this red candle will be your support candle. Support, like candle which is taking RSI to the support. So firstly, once the price is open at this level, you will put your buying order above the high of this green candle, this red candle. If that is crossed the neck on that same day, that's great. You are entered into the market and the market will start going. If that does not happen, you will get other scenarios as well. I'll show you. I'll show you some other examples. Look at this. Market went up, it came down. You, in case you miss this big move, okay, that's no problem. When it gives a dip, what do? You wait. So this red candle took the price down to 60 level, almost 60 level. It can be a bit higher or lower because market will not show you picture perfect scenario all the time, as I always say, right? So first order, when the next candle is forming, your first order will be over here. Okay, in case if the market goes up today only, then I want to buy above this candle. Okay, fine. What happened is it made a doji. Perfect, no issues. The moment the doji, high of doji is crossed, you buy and the market goes up. What will be your stop loss? The low of this small stop loss. Shorting. So let's say you want to trade the breakdown. This can also be the case, right? If you miss the breakdown, this was the breakdown, this was the entire range. Market gave a strong breakdown of this range. Now, if you trade this breakdown, you will sell below the low of this and your stop loss will be somewhere here. Can you see the huge stop loss? If it is not fitting in your risk reward ratio, it is completely fine to leave the trade. But you miss the trade, right? So it is going down, 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 down. Now it is going up. It is taking resistance on 40. right? This green candle is taking the RSI up and taking resistance on 40. So the moment the green candle's low will be broken, you will short the market again and the market will start. It is the opposite of you buying. So in when you buy, you whichever the candle is taking support or taking resistance, in the buying side it is support. You buy above the high of that. Here you short below the low of that, and the market starts going down. And the stop loss is just this very small. Now, if you have taken a trade here, what can you do? You can re-enter, you can increase your quantity. Or what you can do, you can shift your stop loss from this level to this level. So now, if you would have entered here, you will, even if the market comes down to this level, you will exit at a profit only because you shorted this level and you are exiting at this level. That's your profit. So you can shift your profit, you can trail your profit. Okay. Trail your stop loss. Sir. Where is the example over here? I can't see any. Okay. In this case, in case you missed this breakout, fine. But whenever the market goes down, try to take support at this level. It's not a perfect support, although, but fine. This candle is our alert candle. You can put a buy order above the supporting candle, and it was executed, and the market goes up. Look at this. In case you miss this bumper move, what can you do when the market starts going down? You wait. That what candle takes the RSI near 60. This red candle took the RSI near 60. If the high of the this candle is broken, that's great. The support is confirmed, right? Because if and you'll say why the support is confirmed, because we want the RSI to turn up, right? We want the RSI to turn up. Okay, so here when a green candle is forming and crossing the high of the previous candle, that means the RSI has turned up already. That means support has been taken. So you will buy and the market will go up. Another bumper move captured. Okay, you short, you miss this bigger move. So what will you do? You will short at this candle is low. This is taking resistance and the market will go down. That's your small stop loss. Look at this. Over here, look at this. In case you miss this entire trend, where can you buy again? This is where you buy again. This red candle taking the RSI at 60 level. Fine, perfect. Now you firstly you will put your buy order above the high of this candle. But what happened is it made a candle which is inside bar and also whatever you call it. But if you don't know that pattern, what happened is market made a green candle. That means the closing is above the opening. That means the RSI has turned up. That means the support is confirmed. So of course your trade was not activated on that day because the market did not went above this high. What will you do is next day you will buy above the high of this high, green candle's high, and the market will go up. Look at this. Miss this move, no problem. You can short at this resistance, okay, and the market will go down. Miss this move, no problem. You can short at this resistance, sell on rise, buy on dip, sell on rise. So you sell on rise and the market went down again. Why? Because 40 resistance, right? So this is how the 60 support, 60 resistance, 60 support and 40 resistance actually work. Now, let's talk about another concept today of the same RSI. Now you might be wondering, kitna RSI? But as I said, you will understand each and every, like, which is the best tool which you learn which you know the most about. So you will learn a great deal about RSI in today's session. So let's talk about the next concept of RSI is something called as range shift. It's very easy. Don't worry. Nothing complicated. Range shift. Now RSI has three ranges, right? What are those three ranges? Bullish, bearish. Okay. But these are the only two ranges. We call this as a sideways. That's okay. Sideways is not a range. It's just a, so here, if you see above 60, the market is bullish. Okay. Above 60, the market is bullish. So can I say below 60, the market is not bullish? It's either sideways or bearish. Correct. Secondly, we say below 40, the market is bearish. Below 40, the market is bearish. So can I say above 40, the market is not bearish? It is either sideways or bullish. So what is happening over here is if the market shifts from a bullish to not bullish range or bearish to not bearish range, that is called range. From bullish to not bullish or from bearish to not bearish, that is called range. What do I mean by it? Look at this. This is called bearish range shift. Why is this called bearish range shift? Market was in bullish range. Before that, it was above 60. Then it went below 60, took a resistance at 60. 60 is a support, right? We know 60 takes a support and then goes up. But support also acts as resistance, right? Laws of polarity in the market, change in polarity. So now the market is saying, I am not bullish anymore. I can't go up anymore now. So I'm changing my range from bullish to not bullish. So this change in polarity is called range shift. It's called bearish range shift. Why? Because the market is not bullish anymore. Another example, this is called bullish range shift. Why? Because below 40 the market was bearish. Now market is saying I'm going up and now I'm not getting bearish anymore. If I'm not getting bearish anymore, what does that mean? I am getting bullish. That's why it's called bullish range shift. I am shifting from bearish range to bullish range. That's why bullish range shift. And this is not any range shift. That this is a normal 60s 40 support. This is not any range shift. Market was not in a range, bullish range or bearish range before taking a support resistance. That's why this is not a range shift. A lot of people they get confused. This is also a range. This is also no. This is not a range. Okay, I'll show the example. Look at this. Market was bearish below 40. Then it went above 40, took a support on 40. This is called bullish range shift, and then the market goes straight up. Look at this. And how can you trade the support? You know the rule of support. Whenever the market comes to support, this candle take it to support. You either buy above the high of this or you wait for the confirmation for a smaller candle or maybe a doji or something like that. So it was a smaller, like it crossed the high of this candle. You bought at this candle, this green candle, and the market starts going bullish range. Another example, market was bearish, right? It was going down, down, down. Then it went up a little bit. You missed this. Okay, fine. Then it went down. It went down and took a support at 40. Support at 40 means it's not going down anymore. It's not bearish anymore. It is giving a bullish range shift. So this candle dragged to the support. You will buy above the high of this red candle. You bought and the market went all the way to this. What's your stop loss? The low of this is your stop loss. This is your size of stop loss. This is the size of your target. Imagine your risk reward. Bearish range. What is bearish range? Market was going up, 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 above 60, 60, 60. Then it went down a little bit. It went down. Now it's saying I'm not going to go above 60 anymore at this green candle. What will you do? You will firstly try to sell below this low. What happened is this was not crossed the next day, but there was still a red candle which showed that okay, market is turning down from the top. RSI is turning down because it is a red candle, right? So now you'll not sell below this. You will, because you got the confirmation of the resistance, you will sell below this directly. The moment it was crossed, you will sell and the market goes down. That's your stop loss. That's your loss. That's your reward. Imagine the risk reward. Now this is not change in polarity. Can you see this? This was nowhere. This is change in polarity. It was below 40, it went up, it took a support, it went up, right? Below 40, it went up, it took a support, it went up. This is change in polarity. But this support of 40 is not a change in polarity. We will not trade this. Look at this. Below 40, change in polarity, range shift. Below 40, range shift, you buy and the market goes up. These are not change in polarities. These are not range shifts. Below 40, below 40. Went up, went up. Went down, RSI went down, took a support on 40. So the moment you see support, hammers and all, you buy above the high of them, the market goes up. This is also head and shoulder pattern. Confirmed with the momentum. You see this shoulder and this shoulder is the same. But one shoulder was below 40, another shoulder was above 40. What is this? Price level is the same, momentum is different, divergence, range shift, pattern. You can also confirm this with volume. Done. These are the bumper moves that you get after so much of confirmations. Correct. Look at this. Breakout above 60, you buy, then it gives a little bit of dip over here. You buy at the support, you buy above the high of this, it goes up again, gives you a great target, then it goes down. Okay, fine. It goes down below 40, below 60, takes a resistance over here. So this is the resistance candle, which is taking the RSI to resistance. Okay. Firstly, you will try to sell this below the low of this. But then the next candle was formed, which is a tweezer top. And if you don't know the tweezer top, then again, it is confirming that, okay, the market is taking a resistance. So you will sell below the low of this and then the market will go down. Look at this range shift. It was going above 60. That's great. It went down. RSI went down. It went up. RSI went up. It took a resistance on 60. It took a resistance over here. Right? Can you see head and shoulders? Neckline breakdown. You can short here. You can also short on the breakdown and the market goes down. See, good trend. You captured it. You also bought on the support of 60. That's great. Then it went even more high. That's great. Then it went down. So you exit your trade. Okay. Once it's down, you exit your trade. Then it goes up a little bit. So it goes near RSI 60, but from the lower level. So you don't want to say कि अब ये ऊपर जाएगा 60 के ऊपर. No, you can't say that. We are following the market. But if it goes above 60, we will buy. But as of now, it is taking resistance. Okay. So what will we do? We will sell and the market goes down. Look, it's another bullish range shift. Not a perfect one, but still bullish range shift. Now look at this. Don't you think it's a double bottom? First bottom, second bottom. Confirmed with range shift. You buy on the breakout and the market goes up. Momentum. Look at this. What can we see over here? Below 40 at this level. It was going down. Then it went up. Okay. Then it went down. It means near 40 level. Okay. So now you either buy above the high of this. The next candle crosses the high of this. You buy. It crossed it. You buy and the market goes a little bit up. Did not give you a great target, but it went up. Now you want to buy at next support? No, that's not what we do as of now. You can, but the results are not very promising. Now in this example, you might see कि नहीं नहीं यहाँ पे भी buy करेंगे, यहाँ पे भी sell करेंगे 60-40 पे. But there is another strategy for that. Wait for that. Don't hurry. Okay. Don't make conclusion. Just learn what I'm trying to show you as of now. Look at this range shift. It was above 60, so you might have bought. It is going up. Okay. It went down. It went up. So it made a resistance at 60. So you short the market below the low of this candle, and then the market goes down. The more you see, the more you like it. Look at this bullish range shift over here. Zoop, 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 zoop. Up. Now this in a way is a double top as well, right? Double bottom. Correct? Multiple confirmations, multiple chart is speaking to you. Everything is there on the chart. What time is this? Oh my God. And the last concept today is, yes, finally the relief. The last concept for today is something called as RSI divergence. Now, you guys know what divergence is, right? Deviation from the price or the price movement, not the deviation. Like price is going in another direction, your tool is going in another direction. That is divergence. We talked about volatility divergence. Let's talk about momentum divergence as well. So, and divergence is mostly because there is going to be a reversal. Otherwise, there won't be any divergence. If the momentum is strong, okay, and price is also going up, then what is the chance of reversal? No chance of reversal. But let's say the price is going up, but momentum is going down, or volatility is going down, just like we saw in the double top, double bottom scenario. Price was making the same highs, volatility was not. That gives a reversal. Similarly, if the price is, and that was seen by volatility. Now, similarly, if the price, let's say, is going up and momentum of the market is going down, that simply says that from the momentum point of view, market can give a reversal. How it is done? Okay. Price make a higher high or like a new extreme, and RSI makes no new extreme. I'll show you like look at this simple example. If the price is making higher high, this is a higher high, and but RSI is making a lower high. That means price is going in this direction, RSI is going in this direction. There's a deviation of the path. This is our RSI divergence. Similarly, if the market is in bearish momentum, that means the market is making lower lows, but RSI is making higher lows. Market is making lower lows. Market price is saying कि मैं नीचे जा रहा हूँ. RSI बोल रहा है कि नहीं नहीं अब bearish momentum नहीं बचा मैं ऊपर जा रहा हूँ. That means again there's a divergence. They are not in the same direction. They are in the opposite direction. That's your divergence. Price is going up. RSI का momentum नीचे जा रहा है. Again the opposite direction. Look at this. Now, how will you identify this? The most simple way of identifying this is if there is a difference in the highest point of the market and highest point of RSI, there is a divergence. Look at this. The highest point of market is here. Closing basis pay, okay? Closing basis pay. Just give me 1 second. So अगर आप यहां देखेंगे एक हाई मार्केट का यहां है, ओके, एंड हाईएस्ट पॉइंट मार्केट का यहां है. लेकिन जब हम आरएसआई की बात करते हैं तो आरएसआई जो है जहां पर यहाँ हायर हाइज बन रहे हैं, काफी सिग्निफिकेंट हायर हाइज बन रहे हैं, यहां पर इसने एक तरह का डबल टॉप पैटर्न फॉर्म किया. मतलब मार्केट का प्राइस ऊपर जा रहा है, आरएसआई फ्लैट हो रहा है. इसका मतलब क्या है? डाइवर्जेंस, अलग अलग रास्ते हो गए हैं. और जब ये होता है एक स्ट्रेट डाउनफॉल हमें देखने मिलता है. ओके, अब अगर आप यहां ध्यान से देखेंगे तो ये एक तरह का हेड एंड शोल्डर पैटर्न भी है. शोल्डर, हेड, शोल्डर, करेक्ट. दो जो ये टॉप बने हैं वहां पर आरएसआई डाइवर्जेंस दिख गया. तीसरे टॉप के अंदर रेंज शिफ्ट दिख गई. इससे ज्यादा कंफर्मेशन मोमेंटम की तरफ से आपको और क्या चाहिए? शॉर्ट द मार्केट एंड इट विल गो स्ट्रेट डाउन. ऑन दी अदर हैंड अगर आप यहां देखेंगे, दिस इज फर्स्ट हाई, दिस इज सेकेंड आई, ये थोड़ा सा नीचे की तरफ, ठीक है। और यहां पर आप देखेंगे दिस इज द फर्स्ट आई, दिस इज द सेकेंड आई, ये भी थोड़ा सा नीचे की तरफ है। तो यहां पर रेंज शिफ्ट नहीं है, सॉरी यहां पर डाइवर्जेंस नहीं है, मोमेंटम डाइवर्जेंस नहीं है। तो इसको हम इतना सक्सेसफुल नहीं मानेंगे, भले ही नीचे गिरा, ठीक है, होगा, बहुत बार होगा कि आपने इसको इग्नोर किया और फिर भी मूव कर गया, लेकिन हम हमारे कंफर्मेशन, हमारी प्रोबेबिलिटी के ऊपर काम करते हैं। लुक एट दिस, फर्स्ट बॉटम यहां, सेकंड बॉटम, ये फ्लैट, लेकिन ये ऊपर की तरफ जा रहा है, डाइवर्जेंस, डबल बॉटम का ब्रेकआउट एंड स्ट्रॉन्ग अप। लुक एट दिस, ये क्या है, 5 बार डाइवर्जेंस, 1 2 3 4 5, सॉरी 3 बार डाइवर्जेंस, ये जो टॉप है, ये टॉप है, इसके बीच में सिर्फ 3 बार है, 3 बार डाइवर्जेंस, ये जा रहा है ऊपर की तरफ, ये जा रहा है नीचे की तरफ, ब्रेक डाउन एंड स्ट्रेट डाउन। Highest point of the market is this, right? And highest point of the trend RSI is this. इनमें बहुत फर्क है, ये नीचे की तरफ जा रहा है, ये ऊपर की तरफ जा रहा है, डाइवर्जेंस एंड मार्केट गोज डाउन। यहीं पर ट्रिपल बॉटम या ट्रिपल टॉप एक तरह से हेड एंड शोल्डर भी बना है, एंड द मार्केट गोज स्ट्रेट डाउन। डबल टॉप फ्लैट, और ये एकदम नीचे की तरफ, नेकलाइन का ब्रेक डाउन एंड स्ट्रेट डाउन, डाइवर्जेंस। ये ऊपर की तरफ जा रहा है, ये फ्लैट हो चुका है, ये ऊपर, ये फ्लैट, RSI ब्रेक डाउन एंड स्ट्रेट डाउन। लुक एट दिस, ये नीचे की तरफ दो बॉटम जो है, पहला लो यहां बना है, दूसरा लो यहां बना है, लो मतलब क्लोजिंग बेसिस पे जो लो है वो यहां है, दूसरा बॉटम यहां है, ये ऊपर की तरफ बॉटम्स बना रहा है, करेक्ट। ये नीचे की तरफ, ये ऊपर की तरफ, डाइवर्जेंस, नेकलाइन का ब्रेकआउट एंड स्ट्रेट, राइट। तो इस तरह से आपको अलग अलग डाइवर्जेंस देखने मिलेंगे। जब आपको वोल्टिलिटी डाइवर्जेंस मिले तो वो वोल्टिलिटी का कंफर्मेशन है, जब आपको एक तरह से मोमेंटम का डाइवर्जेंस देखने मिले, वो मोमेंटम की तरफ से कंफर्मेशन है एक ट्रेड लेने का। अब कुछ प्रैक्टिस करते हैं, लेट्स सी, देखते हैं मार्केट में क्या क्या चल रहा है। हमने RSI लगा रखा है, ठीक है। हम अगर इसको बॉलिंजर बैंड के साथ कंबाइन भी कर दें, हमने कुछ बॉलिंजर बैंड की एग्जांपल देखे थे, राइट, उसको देखते हैं, मजा आएगा। You will see what is the real power of confirmations. Okay, look at this. यहां पर सेम हाइज बन रहे हैं, यहां पर RSI नीचे की तरफ जा रहा है, मोमेंटम नीचे की तरफ जा रहा है, राइट, हल्का सा डाइवर्जेंस है, मार्केट स्ट्रेट डाउन, वॉल्टिलिटी का तो है ही। लुक एट दिस, ये हल्का सा नीचे की तरफ, ये तो ऑलरेडी है, ये भी नीचे की तरफ जा रहा है, चलो ठीक है, इसमें डाइवर्जेंस नहीं है। ये ऊपर की तरफ जा रहा है, RSI नीचे की तरफ जा रहा है, डाइवर्जेंस एंड डाउन, ये नीचे की तरफ जा रहा है, चलो ठीक है। दिस इज नॉट डाइवर्जेंस ऑल्सो, यहां मैं दिखाता हूं आपको। ओके, लुक एट दिस, ये ऊपर की तरफ है, RSI फ्लैट एंड स्ट्रेट डाउन, ये नीचे की तरफ है, RSI तो दिख नहीं रहा है, चलो ठीक है, ये ऊपर की तरफ जा रहा है, RSI नीचे की तरफ जा रहा है, स्ट्रेट डाउन, राइट। वोल्टिलिटी का भी डाइवर्जेंस, RSI का भी डाइवर्जेंस, मल्टीपल डाइवर्जेंस, कंफर्म एंड डाउन, राइट। सो नाउ इट्स योर टर्न टू, आपके पास कल शाम तक का मौका है, मतलब आपके पास नेक्स्ट सेशन जो सैटरडे को है तब तक का मौका है। गो एंड वॉच इट, गो एंड वॉच दिस, गो एंड प्रैक्टिस दिस। एंड वन मोर थिंग, वन मोर थिंग, एक और बहुत ही इंपॉर्टेंट नगेट RSI डाइवर्जेंस के अंदर है। जितना कम बार के डाइवर्जेंस होगा, मतलब अगर 5-6 बार का डाइवर्जेंस है, 10 बार का डाइवर्जेंस है, 20 बार का डाइवर्जेंस है, तब तक ठीक है। उससे ज्यादा हो गया तो वो अपना सेंस, कभी एक हाई यहां बना है और दूसरा हाई इतना चल के यहां बना है, तो इनका जो डाइवर्जेंस है वो मैटर नहीं करता। जितना पास पास का डाइवर्जेंस होगा, 5 बार, 10 बार, 20 बार, 15 बार, उतने का होगा, तब तक उतना स्ट्रांग होगा। जितना बड़े उसमें जाने के बाद डाइवर्जेंस बनेगा, उतना फिर वो वीक होता रहेगा। राइट, सो ये थी मेरी तीनों सेशंस जहां पर हम अपने टूल्स की बात हमने थर्ड वाले में कर ली है। और या आई एम रियली रियली एक्साइटेड फॉर योर लाइव सेशन, एंड आई कांट वेट फॉर दैट। सो आई विल सी यू देयर एंड प्रैक्टिस everything that we have done so far, combine everything that we have done so far, and I'll see you in the live session. Till then, keep learning with Ediglobe. Bye.